Your investments are underperforming, even when the market is doing well. Not because you chose the wrong companies, but because of something quieter. Something built into how individual investors operate without realizing it. Most people believe investing success comes down to intelligence. Research more, pick better stocks, follow the right strategy. It feels responsible, rational, even disciplined. The idea is simple. If you make good decisions, your money should grow faster than average. But something doesn't line up. Year after year, data shows that most individual investors earn less than the very funds they try to outperform. Not slightly less, significantly less, even during strong market periods, even when they're active, informed, and paying attention. The effort increases, but the outcome drifts further away. At first, the effect looks small. You notice missed opportunities. A stock you sold too early, another you held too long. Gains that disappear before they compound. Losses that linger longer than expected. It feels like timing, like randomness, like bad luck repeating itself. But it isn't random. Beneath those visible outcomes is a quieter mechanism, one that doesn't rely on knowledge or effort. It operates through structure, through how decisions are made, how attention moves, how money enters and exits the market. Funds don't think the way individuals do. They don't wake up and reconsider everything based on headlines or emotions. They don't react to short-term fear or short-term excitement. Their structure removes the need to decide constantly. And that changes everything, because every decision introduces friction. Every time you choose to buy, sell, wait, or adjust, you're not just acting on information. You're acting under pressure, time pressure, emotional pressure, uncertainty. And that pressure slowly erodes consistency. Funds don't eliminate risk, but they eliminate decision frequency, and that shifts the outcome. The visible effect is simple. Funds appear to grow steadily, while individual portfolios move unevenly. Periods of growth followed by hesitation. Periods of confidence followed by correction. It feels active, engaged, responsible. But underneath, something else is happening. The invisible mechanism is behavioral drag. Not a single mistake, not one bad trade, but a series of small deviations from consistency. Entering too late, exiting too early, holding when uncertain, selling when uncomfortable. Each action feels justified in isolation. Together, they create a pattern, and patterns compound. Funds operate differently, not because they predict better, but because they commit differently. Many follow predefined structures, index tracking, allocation rules, rebalancing schedules. They don't react to every signal. They follow a system that limits interference. That limitation becomes an advantage, because the more you interact with your money, the more you expose it to error. This creates the behavioral trap. You believe involvement improves results, monitoring, adjusting, optimizing. It feels like control, like responsibility. But increased involvement increases the number of decisions, and more decisions increase the probability of deviation. So you stay engaged, you check prices, you read news, you adjust positions, you try to protect gains, avoid losses, capture opportunities. Each action feels necessary. Each one introduces a small shift away from consistency. And over time, those shifts accumulate. Funds don't try to optimize every moment. They accept the average path. And because they stay on that path, they capture more of it. That's the contradiction. Trying to outperform often leads to underperformance, not because the strategy is wrong, but because the execution becomes unstable. Then comes the structural lock-in. The longer you invest this way, the harder it becomes to stop. Experience reinforces confidence. Even when results lag, the belief remains that the next decision will correct the previous one, that more effort will close the gap. But the structure doesn't change. More decisions, more reactions, more exposure to noise. The system continues quietly, producing the same outcome under different conditions. And time amplifies it. Because investing is not just about returns. It's about consistency over long periods. Small differences in behavior become large differences in outcome, not immediately, But inevitably, this is where the recognition begins. You save regularly, you invest with intention, you follow financial news, you care about your future. You're not careless with money, you're not uninformed. You're doing what most people consider responsible. And still, something feels off. Progress doesn't match effort. You compare outcomes. Broad markets rising steadily, funds tracking them closely, your own results moving differently. Slightly behind, then further, then noticeably. Not enough to alarm, but enough to question. So you adjust again. Change strategies, shift allocations, try new approaches. Each one based on logic. Each one introducing another layer of variation, another deviation from consistency. And the system continues. Because it was never about intelligence, or access to information, or even discipline in the traditional sense. It was about structure, about how decisions are distributed over time. Funds remove the need to decide constantly. Individuals don't, and that difference compounds quietly. The identity collision happens here. Working more, earning more, saving more, trying to be careful, avoiding mistakes, seeking stability, following advice, staying informed. All of it aligns with the belief that control improves outcomes. But in this system, control behaves differently. More control can mean more interference. More awareness can mean more reaction. More effort can mean more deviation. And none of it feels wrong while it's happening. That's what makes it difficult to see. Because nothing looks broken. The process feels active, responsible, engaged. The outcomes are close enough to expectations to avoid immediate concern. Until enough time passes to reveal the gap. And by then, something else has already happened. Time has moved, not dramatically, not suddenly, gradually. Years of investing under a structure that introduces small, consistent deviations. Years where compounding could have followed a smoother path. Years where the difference between staying aligned and drifting away begins to widen. This is the point of no return. Not because change is impossible, but because time cannot be recovered. The compounding that didn't happen, the growth that was interrupted, the opportunities that passed quietly while decisions were being made. Lost leverage, lost simplicity, lost alignment with the system that rewards consistency over activity. And the most difficult part is that none of it feels like a clear mistake. It feels like participation, like responsibility, like doing what you're supposed to do, which is why it continues. Because the system doesn't announce itself. It doesn't signal when you've crossed into underperformance. It doesn't highlight the cost of each additional decision. It operates quietly, producing outcomes that seem close enough to normal, until they're not. And by then, the pattern is already established. Because this isn't about funds being smarter, or individuals being less capable. It's about structure favoring consistency over intervention. About a system where less frequent decisions can produce more stable outcomes. And once that becomes visible, something else begins to shift. Not in the market, not in the funds, but in how every decision starts to feel slightly different. Because now there's a question that didn't exist before. Not whether the next decision is right, but whether making it changes the outcome at all. And that question doesn't go away. It follows every movement, every adjustment, every moment of uncertainty. Because the system hasn't changed, only your awareness of it has. And once you see it, the difference between action and interference becomes harder to ignore, even when everything else looks the same. Especially then, because that's when the system is working exactly as it was designed to. Quietly, consistently, without asking for your input. And the realization is just beginning. For more long-form thinking about investing, incentives, and financial systems, subscribe to Finance Simplified.